If you have $10,000 sitting in a traditional bank account right now, you are secretly losing hundreds of dollars every single year. Standard interest rates of 0.01% provide no defense against inflation, which quietly siphons value away from your account. At a traditional bank paying that rate, your $10,000 deposit earns exactly $1 in profit over an entire year. Compare that single dollar to the current U.S. economy, where the cost of living is rising at an average of 3 to 4%. This chart tracks a $10,000 deposit over 5 years. The top line is your bank's interest. The dropping shaded area is inflation eroding your purchasing power. At year 5, that gap measures the groceries and travel you can no longer afford. Brick-and-mortar bank accounts market themselves as the safest place for your cash, but they are a guaranteed way to become poorer over time. Legacy brick-and-mortar institutions built their business model on a specific type of math. They take your deposits, pay you a fraction of a percent, and lend that exact same money out for mortgages and credit cards at 7 to 21%. The bank pockets that massive profit margin for themselves, while you are left holding 100% of the inflation risk. The immediate fix to reverse this decay is a high-yield savings account, or HYSA. Because most of these are online-only institutions, beginners often worry about what happens if the bank fails. This label provides the legal protection you need. As long as the account is FDIC-insured, the U.S. government guarantees you will get every penny back, up to $250,000. With the safety confirmed, we can look at the return. A good HYSA pays around 4 to 5% interest, which is a 500 times increase in passive income on autopilot. To get this yield, you have to trade the ability to walk into a physical branch for digital apps and remote customer service. Leaving the familiarity of your local bank teller is the required price of admission to protect your wealth. Simply chasing the highest rate is usually a mistake because the day-to-day friction of using the account matters just as much as the yield. Look at this matrix evaluating the top accounts by interest, minimums, features, and requirements. Marcus by Goldman Sachs offers elite Wall Street backing with 0 fees and 0 minimums. However, its bare-bones interface lacks advanced goal tracking tools. Ally Bank takes the opposite approach, focusing on visual organization. Their Buckets feature splits one savings pool into distinct goals, like a house or emergency fund. The trade-off for this superior app is a slightly lower maximum interest rate. The choice between these two depends on whether you value frictionless simplicity or psychological budgeting tools. For those who refuse to settle for anything less than the absolute highest interest rate, SoFi is the heavyweight option. Returning to our matrix, we can see SoFi takes the top spot for interest. To unlock that rate, SoFi requires you to set up and route your employer direct deposit straight into the account. If you transfer cash manually without this setup, the account's yield plummets to a non-competitive rate. You must be willing to change your core payroll settings in exchange for that maximum financial return. SoFi is a tool for aggressive optimizers. It is the wrong choice for anyone looking for a passive, low-effort parking spot for their cash. Look at this decision tree. Are you willing to switch your direct deposit? If yes, choose SoFi to maximize yield. If no, ask yourself if you need visual subcategories for goals. Yes, route to Ally. No, route to Marcus for simplicity. Regardless of your choice, the setup takes less than 10 minutes online and has no impact on your credit score. Open your banking app now, find your current interest rate, and drop the name of your bank in the comments below. Allowing big banks to exploit your savings is a choice. Protecting your hard-earned money begins with making this single mathematical switch today.